Hey everyone, this is Jake. So today we're going to be talking about the 1929 stock market crash and also tying it into what's gone on with the coronavirus situation in the stock market. And this is very relevant because when we're talking to our students, we need to help them make connections with history, and this is a good way to do it because everybody likes money. So, the 1920s, what was happening is there was a rapid expansion of the economy because World War One was over, new technologies, and everybody is trying to make lots of money, and credit is good. So, what is going to occur is that there was a problem, especially from the people that are going to be purchasing stocks, and the problem was called margin. We still have this today, but what margin is you need today you need 50% because of what happened back then. So if you wanted to buy $1,000 worth of stock, you can borrow up to $500 of the money from a brokerage. The other 500 needs to come from you. Well, in 1929, these guys were trading on 10% margin, meaning that you only needed $100 in order to trade $1,000 worth of stock. And it's really nice if you don't have a lot of money because you can leverage this to create massive returns. And then you just pay back the $900 plus a little bit of interest to your broker. The problem is, and it works nicely when everything's going well. The problem is what happens when that money that you borrowed is now coming due and you didn't have that amount of money and you're having to pay interest. And so these guys are going to get margin called, and this is going to be really bad. We actually saw this happen to I'll use a company here in Atlanta called Invesco. They were a massive mortgage REIT company, and they were leveraged at like 7 times of what they actually had, and they were forced to liquidate most of their assets. They went from being a $18 billion company that they managed assets to like less than $3 billion. So massive drop. And the same kind of stuff is happening in the 20s. So there's that situation. Plus there is outright fraud going on. The company RCA was actually doing quite well at the time, but it's very similar to what's happened with GameStop, where but this was actually insider trading here in RCA's case, where people were actually buying the stock in the company and they just kept buying it and purchasing, and so they could get the price to go up because they'd be like, wait, this stock is going up, so we got to buy it now because it may never be this cheap again. And so this creates this kind of euphoria about buying the stock, and then once those insiders got the price they wanted, then they just sell out immediately. But then once the sell happens, then you see the price drop even more dramatically, and this is going to happen not just here, but it's going to happen in many other stocks, and it doesn't even matter about the fundamentals anymore because people are just outright panicking. And so people are going to sell out of stocks that even when they were successful. And the key is just hold what you got. So people that, according to Philip Fischer, he actually talks about it in one of his books, if you had invested $10,000 in 1929 and you would have held it through 1950, you would have been worth at least $250,000. And that's back in that day's type of money, which is significantly more than now. If we want to tie it into a modern example, so I'll use Home Depot. Home Depot, people were buying at $200 back in 2019. It dropped down to $150 in March of 2020 when people were panicking and scared because of coronavirus. If you still hold that stock today, it's worth $325. So people lost over a quarter of their investment where they sold and panicked. But if they had just kept it, not only would they have been made whole, but they would have actually gained a 50% profit. And so this is one thing we got to pay attention to, and with avoiding panic. But this actually was even happening to some big time guys. The founder of General Motors had an estate worth $120 million. But in 1929, but by 1936, he basically lost everything because he was a big market trader and was trading on margin and whatnot. He ends up with $250 when he dies, which is absolutely insane. Another guy who sold out to Dodge had $12 million in his estate. When he dies, it's gonna be worth $89,000. So the key, ladies and gentlemen, is when you buy stock, hold what you got, don't panic.